Ladies and gentlemen, stop what you're doing. Something shifted in the last 72 hours, and most people won't understand what it means until it's already hit their wallets. This isn't about headlines. This isn't about politics. This is about the invisible mechanisms that move your money, your savings, and the price of everything you touch. And right now, those mechanisms are being pulled in directions they weren't designed to go. Let me be very clear about what just happened. Tensions between the United States and Iran escalated again. On the surface, it looks like another cycle, another round of threats and counter-threats, another moment the world has seen before. But here's what they're not telling you. The financial system doesn't care about rhetoric. It cares about choke points. In the Strait of Hormuz, that narrow passage of water between Iran and Oman, is the single most critical energy choke point on planet Earth. Every day, roughly 21 million barrels of oil pass through that strait. That's about 30% of all seaborne traded crude oil. 30%. If that flow gets disrupted, even partially, even for a few days, the entire pricing structure of global energy collapses into chaos. And when energy prices move, everything moves. Food costs more because transportation costs more. Manufacturing slows because input costs spike. Supply chains that were already fragile start breaking in real time. Now here's where it gets interesting. In the last 48 hours, oil futures didn't just tick up. They spiked, pulled back, then spiked again. That's not normal. That's panic buying followed by forced selling followed by panic buying again. Someone is hedging, someone is positioning. And whoever they are, they're moving size. When geopolitical risk enters the oil market, the first thing that happens is the options market goes berserk. Traders start buying call options, betting prices will surge. But they also buy put options, betting prices will crash if conflict is avoided. The cost of these options, implied volatility, shoots through the roof. Right now, implied volatility on crude oil options is sitting at levels we haven't seen since the early days of the Ukraine invasion. But oil is just the beginning. Let's talk about what happens to currencies. The moment there's a threat to Middle Eastern stability, global capital flows change direction. Investors pull money out of emerging markets and push it into safe havens. The US dollar strengthens because it's still the global reserve currency. The Japanese yen strengthens because it's a traditional safe haven. And currencies tied to commodity exports, like the Canadian dollar, the Australian dollar, and the Norwegian krone, they start moving with oil prices. Here's the part most people miss. When the dollar strengthens rapidly, it creates a hidden tax on the rest of the world. Most global debt is denominated in dollars. Countries, corporations, and banks around the world owe trillions in dollar-denominated debt. When the dollar gets stronger, that debt gets harder to pay back. That pressure builds. And when it builds long enough, something breaks. Now let's talk about what this means for you, sitting at home, watching prices change at the gas station, at the grocery store, in your brokerage account. If oil prices go up by $20 a barrel and stay there, the average American household will spend an extra $500 to $700 a year on gasoline alone. That's direct, visible, painful. But the indirect effects are much larger. Airlines raise ticket prices, shipping companies raise freight costs. Those costs get passed down to every product that moves. And then there's inflation. Central banks spent the last 2 years fighting inflation, raising interest rates, trying to cool down economies. They were winning. Inflation was coming down. But an oil shock changes everything. If energy prices surge, inflation comes roaring back, and central banks are stuck. Do they keep raising rates and risk a recession, or do they pause and let inflation spiral? There's no good answer. And when central banks don't have good answers, markets get very nervous. But here's what really keeps me up at night. This isn't just about oil. Iran has been very clear about its capabilities. If pushed, they've said they can close the Strait of Hormuz. Not just threaten it, actually close it. They have anti-ship missiles, they have fast attack boats, they have mines. And while the US Navy is powerful, even the Pentagon admits that keeping that strait open during active conflict would be extraordinarily difficult. Let's game this out. If the strait closes for even 1 week, global oil supply drops by 15 million barrels a day. The strategic petroleum reserves can cover some of that, but not all of it, and not for long. Prices don't just go up, they explode. We're not talking about $80 oil or $100 oil. We're talking about scenarios where oil briefly touches 150, maybe higher. And here's the kicker. The global economy is far more fragile now than during previous Middle Eastern crises. Debt levels are higher, growth is slower, the buffer that used to exist, the spare capacity, it's gone. OPEC's spare capacity is at multi-decade lows. U.S. shale producers are drilling less aggressively. There's no cavalry coming if supply gets cut. Now, let's talk about gold. While all of this is happening, gold has been climbing quietly, steadily, without much fanfare. And in the last 72 hours, it broke through a key technical level. Gold doesn't care about earnings. It doesn't care about growth. Gold cares about one thing, fear. And when fear enters the system, gold becomes the only asset without counterparty risk. What does that mean? When you own a stock, you're trusting a company. When you own a bond, you're trusting a government or corporation to pay you back. But when you own gold, you're trusting nothing and no one. It's pure value, recognized across every border. And right now, central banks are buying gold at a pace we haven't seen in decades. They're not doing that because they're bored. They're doing that because they see the same cracks I'm describing right now. Let me bring this back to something specific. The insurance industry is quietly freaking out. Shipping insurance costs for tankers moving through the Persian Gulf have tripled in the last month. Tripled. That's not speculation, that's hard data. Insurance companies are pricing in real risk. And when insurance costs go up, shipping costs go up. And when shipping costs go up, the price of everything goes up. Here's another layer most people aren't watching. Iran is heavily aligned with Russia and China. If this conflict escalates, it's not just regional, it becomes a proxy for larger geopolitical tensions. Russia benefits from higher oil prices because it funds their war chest. China benefits from a weaker U.S. position in the Middle East. And both have been working for years to build an alternative financial system that doesn't rely on the U.S. dollar. This is where it gets really uncomfortable. If Iran, Russia, and China coordinate even loosely, they can create massive disruptions in global trade. We've already seen China and Russia settling oil trades in yuan and rubles. We've seen Saudi Arabia accepting yuan for oil sales. The dollar's dominance, the thing that has allowed the United States to run massive deficits for decades, is being chipped away. Slowly, quietly, but it's happening. And when the dollar loses its status as the global reserve currency, Americans will feel it. Interest rates will be higher because the U.S. government won't be able to borrow as cheaply. Imports will cost more. The standard of living Americans have enjoyed for 70 years, built on cheap imported goods and low borrowing costs, is directly tied to dollar dominance. Let's talk about what this means for the stock market. Stocks have been holding up reasonably well, all things considered, but energy shocks have a predictable pattern. First, energy stocks rally because their profits surge. Then, everything else starts falling because higher energy costs eat into corporate margins. Airlines get crushed, retailers get crushed. Anything with high transportation costs starts bleeding. And here's the part almost no one talks about. The Federal Reserve is trapped. If oil prices spike and inflation comes back, they have to raise rates. But if they raise rates while the economy is already slowing, they risk triggering a recession. And if they trigger a recession while geopolitical tensions are high, the whole situation spirals. This is a loop. And right now, we're at the beginning of it. Now, I want you to think about your own situation. How much of your wealth is tied to assets that depend on stability? How much is in stocks that assume supply chains keep working? How much is in bonds that assume governments can keep borrowing cheaply? How much is in cash that assumes inflation stays low? Because if this situation escalates, every single one of those assumptions gets tested. Here's what I'm watching in the next 2 weeks. First, I'm watching oil inventory data. If inventories start falling faster than expected, it means the market is tightening and prices will keep rising. Second, I'm watching currency moves. If the dollar keeps strengthening and emerging market currencies keep weakening, it means capital flight is accelerating. Third, I'm watching credit spreads. If the cost of borrowing for corporations starts widening, it means investors are pricing in real economic damage. And fourth, I'm watching what central banks do, not what they say. Words are cheap, actions matter. If central banks start intervening in currency markets, if they start coordinating rate decisions, if they start reopening emergency lending facilities, then you know the situation is worse than the headlines suggest. There's something else happening beneath the surface that almost nobody is discussing. Derivative markets are starting to show strain. The notional value of oil derivatives, the contracts that banks and hedge funds use to hedge or speculate on energy prices, runs into the trillions. When volatility spikes the way it has in the last 72 hours, margin calls start hitting. And when margin calls hit, forced liquidations follow. This creates a cascade effect. One forced seller pushes prices down. That triggers another margin call somewhere else. That creates another forced seller. And the cycle feeds on itself until either prices stabilize or something breaks. We saw this in 2008. We saw it during the COVID crash in 2020. We're seeing the early signs of it right now. Pension funds, insurance companies, sovereign wealth funds, they all use derivatives to manage risk. When volatility explodes, their risk models flash red. And when risk models flash red, they're forced to reduce exposure. That means selling stocks, selling bonds, pulling back from markets across the board. In the last week, we've seen unusually large outflows from emerging market bond funds. These are the canaries in the coal mine. Now, let's talk about what happens to regular people. They wake up one morning and their 401k is down 3%, then 5%, then 8%. And they don't understand why, because the headlines are still talking about negotiations. But by the time the headlines catch up to reality, the damage is already done. Here's the cruel irony. Most people's wealth is trapped in systems designed for stability. Their retirement accounts are in target date funds that automatically rebalance. Their savings are in banks that pay almost nothing. Their biggest asset is usually a house, which is illiquid. When markets move fast, these people have no ability to react. They're locked in. This is why wealth inequality accelerates during crises. The people with liquidity, with access to alternative investments, they can protect themselves. They can shift into gold, into commodities, into currencies that are strengthening. But the average person? They're stuck holding assets that are losing value in real time. Iran isn't acting alone. They have relationships, alliances. Hezbollah in Lebanon, the Houthis in Yemen, militia groups in Iraq and Syria. If this conflict escalates, it doesn't stay contained. It spreads. And when it spreads, the risks multiply. Imagine Houthi rebels, backed by Iran, targeting shipping in the Red Sea more aggressively. That's another critical choke point. The Suez Canal handles roughly 12% of global trade. If shipping becomes too dangerous, vessels have to reroute around the southern tip of Africa. That adds weeks to shipping times and thousands of dollars to costs. And once again, those costs get passed down to consumers. China is watching all of this very carefully. Taiwan is their primary geopolitical focus. If the United States gets drawn deeper into a Middle Eastern conflict, its ability to respond to a crisis in Taiwan becomes constrained. China knows this. Russia knows this. Iran knows this. These aren't isolated events. They're moves on a global chessboard. Let me tell you what this isn't. This isn't fear-mongering. This is pattern recognition. Every major geopolitical crisis in the last 50 years has followed a similar script. Tensions rise. Markets ignore it. Then something breaks. A supply chain, a bank, a currency. And once it breaks, the repricing happens fast. The difference this time is the scale. The world is more interconnected. Supply chains are more complex. Financial markets are more leveraged. The geopolitical landscape is more fragmented. The unipolar world that existed after the Cold War is gone. We're in a multipolar world now, and multipolar worlds are inherently unstable. So where does this leave you? You can assume this blows over, like it has before. You can assume that cooler heads will prevail. Or you can recognize that the world is shifting, that the systems we've relied on for decades are under stress, and that stress creates opportunities for those who see it coming and devastating losses for those who don't. I'm not telling you what to do. I'm telling you what's happening. The US-Iran conflict isn't just about missiles and sanctions. It's about energy. It's about currencies. It's about debt. It's about the slow, grinding realignment of global power. And that realignment doesn't show up on cable news. It shows up in your bank account. Pay attention to the details. Watch the markets that most people ignore. Follow the money, not the headlines. Because by the time this story is front page news, the big moves will already be over. The people who positioned early will have protected their wealth. The people who waited will be asking what happened. This is not a drill. This is the early stage of something much larger. And how it plays out will determine the financial landscape for the next decade. Stay sharp.